Good afternoon, everyone, and thank you for joining us today. My name is Greg Burris, and I'm Director of Investments at Foundation for the Carolinas. And on behalf of the entire executive leadership team here at FFTC, we certainly thank you all for joining us today. Before turning it over to Travis and Tim, I just want to mention that if at any time you have a question during the webinar or want clarification on a topic, please post your questions in the Q&A window. The Mercer team will address these after the presentation during the Q&A portion of the webinar. And if we do not get to your question during the session, we will follow up with you after the webinar. And just as a reminder, of course, the webinar is being recorded and a link will be added to the fftc.org website later this week. I'll now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be addressing market conditions and investment performance for FFTC's investment pools during the third quarter of this year. I'll turn it over to you, Travis.
Great, thanks, Greg. Hi, everybody. Welcome back. It's nice to be here again with you all. We'll go through. We'll give you some the good news and the more challenging news and what's been an interesting market environment. We'll give you a sense of where the standard portfolios sit, and we'll, as always, we'll be ready to answer any questions. So let's dive right in with some market notions that are important to the portfolio. Unfortunately, we did see another challenging quarter on an absolute return basis. Rising rates and continued concern about slowing growth have continued to basically pressure most asset classes. You can see we narrowed down our list of indices that we show you each quarter. These are the most important when it comes to your overall portfolios, the way that you're invested across the foundation. And you can see in the top, whether you in US stocks or non-US stocks or even bonds or other diversifying assets or real assets, it's been a pretty challenging quarter as the rising rate environment did put pressure on valuations across the board. The additional impact on our non-US investments, which are these green bars here for IFA and EM, the US dollar was incredibly strong, or has been incredibly strong versus other foreign currencies throughout most of this year. And so IFA stocks in general, actually, which are developed non-US markets, actually were in local currency terms only down about 4% for the quarter. So that additional impact of currency, added to the downward pressure for our non-US investments. We did see US investors begin to bet through part of the summer that the Federal Reserve would pivot and that they would be forced or be willing to change their tightening stance, which is where they have been for much of this year, and to potentially have to pivot and be able to and look on the horizon of cutting rates in the wake of some of these equity market and broader market downward pressures, as well as the potential longer term impact on the economy. And what that led to was investors from, call it mid-June to about mid-August, did reevaluate and place some wagers on some of the higher expectation parts of the marketplace, some of the higher potential growth parts of the marketplace, which is why we see the Russell 2500, which is the US small mid-cap marketplace, outperforming larger cap stocks. We'll have a couple of examples of that as we go through, where there was some change in leadership over the quarter that we had not seen so far in 2022. Fed Chairman Powell, though, put an end to all of that thinking with his response in very brief speech at Jackson Hole conference in late August, where he made it clear that the Fed is planning to remain diligent in fighting inflation. And as a result, the market realigned, and we did see a somewhat more difficult or more challenging period in September. One place where the rising rate environment has been an advantage actually is in the very short end of the curve and in cash rates. And for a long time, cash and money market funds were delivering very close to zero. We have finally seen those assets start to tick up on an absolute return basis. If we just take that out and translate that to the rest of the year to date, it has been pretty. You can see as well as I can, and I'm sure it's not a mystery to anyone. It's been a pretty difficult year on an absolute return basis, and it really has not mattered much which stocks you own the US is marginally better than non-US and other types of stocks, but by and large, if you've owned stocks in general, it's been a tough year. And that's not necessarily out of the ordinary, but what is out of the ordinary is the response we've seen from the bond market. Because rates have gone up remarkably and off of a very low base, it has translated into pretty meaningful price adjustments for bonds, and that's why we see returns for the Bloomberg aggregate down nearly 15% for the year-to-date basis. Fortunately, across the portfolios, we do have the ability to own more than just stocks and bonds. So we do in the diversified long-term growth. You'll recall that we own some hedge fund exposure, and in all of the longer-term pools, we own other types of natural resource exposure like REITs, which haven't been as helpful for this year, but certainly things like natural resource stocks and commodities, which we're using the commodity index here as a proxy for that discussion. So we have been able to own some of the things that have helped support the portfolios in this downturn, and it reinforces the long-term exposure to different sources of risk and return that we built into the standard pools. And hopefully that will be a little bit more apparent as we go forward. I mentioned that there was a short-term change in leadership, and we did see some of the hardest parts of the market on a year-to-date basis, the hardest hit parts of the market on a year-to-date basis. Investors waded back into those areas during the quarter. And so I've circled all of the growth indexes here, and you can see, relatively speaking, while still negative in 2 of the 3 from a cap perspective, they did outperform the value counterparts in the quarter, even though growth trails by a pretty good margin versus value, regardless of size, over most of the 2022 period. And really that was, in our mind, it was really a sentiment shift. Really weren't a lot of fundamental changes that supported or reinforced why those stocks should go up in the way that they did. So we do think there's a bit of a sentiment shift, and that puts a lot of pressure on this notion of what the Fed's going to do in the markets. This as I was preparing my notes today, and I thought of what I wanted to focus on, what I wanted to reinforce. I think this kind of activity really reinforces why we think it's very difficult to make a lot of short-term moves with consistent success. When you get a sentiment shift and a change in market direction like this, it's really not driven by any change in fundamentals. It can be hard to get these things right, and so we don't. This is why we build the portfolios the way that we do, and we consider these kinds of short-term market adjustments as normal, and we want to try and build robust portfolios that can live through this environment. So we expect the potential for these kinds of rallies to come as we're working through this tough period. We think volatility is going to remain high. And just as example, we saw another shorter term strong rally in the month of October. I haven't gotten the final October numbers yet, but I think October is actually going to be positive across many sectors, but completely different leadership over the October period. Value jumped back to the top of the pile in October. Again, not a remarkable change in fundamentals, but really more so short-term traders expressing opinions on the market. So I thought that was maybe a good thing to just reinforce today as to why you perhaps don't see us making a lot of short-term moves, is we think it's very hard to get those right consistently, and you can actually detract a lot more value through that process than you're trying to add. So where's that volatility coming from? Well, it's perhaps, I have to have the inflation slide on because it feels like if you don't put it up, we're ignoring it, but clearly inflation has gone up, and it's gone up a lot. And that's contributed to volatility as the Fed's had to be active and diligent against that. But what we've seen is the market has evolved their thinking as to what the impact of inflation might be and how diligent the Fed can be. So if you're back, if you've been able to join us over the last several of our webinars, the chart on the right here will seem familiar. This is a market chart that demonstrates in a picture graph, what the market is pricing in or what the market's expectations for overnight lending rates are. So what's the Fed going to do with short rates is basically what this chart measures. And the purple line is expectations at the end of December. So you can see much lower than current environment. The green line is where we were at the end of July, and the blue line is where we are at the end of September. And this shape of the green line implied that the market thought short rates would peak out at about 3.25% around the end of this year into the first part of next year, and that the Fed would actually be actively cutting into 2023. That's what the shape of this curve suggests. The market is clearly evolving its thinking based on Fed actions and words. And so this blue line now suggests that the market is pricing in a terminal rate that is much higher, in fact, something closer to 4.5%, and that rate will be in place longer than previously anticipated. There is growing market consensus that we could see a meaningful slowdown or even a recession in 2023 at some point in time. But the Fed has largely signaled that they're going to continue to raise rates and then perhaps hold those rates as long as it takes to get inflation back something closer to their long-term 2% target. This is a fluid view, and so it's important to realize that the Fed is an active and animal, and even here in October, whispers or subtextual messages within Fed communications have suggested that maybe there's a pause on the horizon. Maybe that pause might be early 2023, but that even those whispers and subtext messaging has helped, put some bid back in the marketplace, and we saw a stronger October, perhaps in part of that. The last couple of market things, and if I haven't, beaten this drum on inflation enough, I'll beat it just one more time. The market is also pricing in success, if you will, by the Fed in getting inflation under control. And so what the left-hand chart suggests are shorter-term inflation expectations as priced by the swaps market. So the blue line is 1 year expectations for inflation, and the green line is 1 year expectations for inflation 1 year from now. And that's a pretty strong view that the Fed is going to be successful and that we'll see inflation fall pretty significantly over the next 12 months. That's what the market is pricing in there. And even on an intermediate term perspective, 5 years out, 5 years forward, the blue line is on the right-hand chart is the spread between the yield available on a 5-year TIPS bond or inflation protected bond and the yield on a regular treasury. And what that suggests is that over the next 5 years, the market is pricing in an expected inflation rate of about 2.5%, maybe a little bit less. And so in the big picture, from a market perspective or portfolio positioning perspective, if one believed that inflation would be greater than 2.5%, then one might buy the TIPS bond. If one believed inflation would be less than 2.5%, then one might buy a regular treasury bond. And that's the activity that investors and security selectors are making every day in this marketplace, positioning against that. We think that these numbers are also fluid and have changed quite a bit. And one might argue that with some structural items on the horizon, some real challenges potentially in the economy, that perhaps the 1 year numbers are a bit optimistic, but we just don't know. And because we don't know, we're not in the position to make large bets either way. But we do think as the market continues to evaluate these concepts around inflation and where inflation will be in the context of the Fed, we expect, if nothing else, we do expect continued volatility as the market works this out. So that's the world. I wanted to try and give you a sense of things that we thought could influence the markets going forward. I'm going to transition now into conversations around the building blocks and give you some color here. And of course, just as a reminder, we do have a set of custom building blocks as well as other direct positions to deliver consistent underlying performance or to pieces to each of the portfolio designs, regardless of your overall asset allocation. So as always, we'll start at the top with equity. It was a pretty difficult quarter for active managers with that leadership rotation back into higher expectation and in some ways lower quality companies or lower quality stocks. Our bias towards quality and a little bit of value actually put us at odds with that, particularly in our equity portfolios or our traditional equity portfolios. So The US and non-US did underperform a little bit in the quarter, but fortunately, with strong performance in the first 6 months of the year, we see both of those strategies continuing to outperform on a year-to-date basis. Within emerging markets, also a little bit of underperformance. We did drop a manager from the emerging markets portfolio in October. Our researchers went back and underwrote that manager again. And the takeaway from that, in the wake of some underperformance and some meaningful risk earlier this year, made the decision that we weren't comfortable with their risk management program. And so we did make the decision to drop that manager. We've allocated those proceeds for the time being into our passive allocation. And we'll be reevaluating that portfolio, but we still feel good about our diversification and our active managers that we retain. We still have 3 active manager positions in that portfolio, as well as the core passive allocation. So more to come on that as we go forward, but we are comfortable with where we sit on that portfolio today. We did see our global opportunity strategy, which is also held only in the diversified long-term growth, squeeze out a small amount of premium for the quarter as we dig back from some underperformance in the first quarter of the year. I talked a bit about early in my preamble about our real assets allocation, and as noted, this basket of assets, which are held in each of the longer term pools, have been added to overall investment performance for the course of the year. Real estate being the one place that has struggled more, and maybe at a different point of the economic cycle or a different point of the economic connection point. But infrastructure has held up really pretty well. You can see for the quarter, the infrastructure manager and infrastructure as a category, if you will, caught up. The first 6 months of the year were better, but the infrastructure did participate, but on a year-to-date basis, performing better. And really, the winner in the clubhouse, if you will, from an equity strategy perspective, has been the investments in natural resource stocks. And there's a lot of news and noise about the profits that, like, say, oil companies are making. These are the exact kind of companies that we own in this part of the portfolio, and that is been additive. They're small allocations, but when the performance or relative performance is this much, it does have a real impact on the portfolio. Looking at the risk reduction assets, starting as we do with the hedge fund portfolio. Again, as I noted earlier, you own the hedge fund portfolio in diversified long-term growth for those holders of that position. And as a reminder, we do own this hedge fund allocation as part of our risk reducing assets, and therefore in lieu of more traditional bond exposure. And so we got a double win, if you will, this quarter with the hedge fund, with your hedge fund portfolio. A modest outperformance against the particular policy index for that strategy, as well as on a year-to-date basis. This hedge fund portfolio tends to have a little bit less market-related exposure, and so when markets scream to the upside, we will perhaps underperform this fund of funds index. When markets underperform or go down significantly, we tend to outperform. That's by design, and fortunately, year-to-date, we're getting that. Additionally, as I mentioned, that we hold this in lieu of additional fixed income, and it's really been, in that context, been really successful. This is what we would hope for in this kind of environment from that allocation. So, like I said, a double win for that position this quarter. We also got a nice little premium out of our active fixed income managers for the quarter, both in our core portfolio as well as in sterling. Our core portfolio, as you may recall, I think we've described this a couple of times, we tend to bias towards corporate bonds, away from treasuries, corporate bonds, and other what are called traditional spread sectors. And while on a year-to-date basis, that has worked against us, that's consistent with our expectation in this kind of environment. As risk profiles changed a little bit in the quarter, we were able to, the managers underlying your portfolio were able to generate some additional premiums. So that's also a really strong result on a quarterly basis that we're very happy with. And obviously, we're not happy with being down 4% in bonds, but if we got to be down, let's outperform. One of the things that we have built in, as you recall, sterling is a single manager in the low duration fixed income standard pool. So if you're an investor there, they are your manager. And so on that basis, you can see getting some good active premium in the tough environment. And then as an additional reminder, we do have a dynamic position in sterling within the longer term pools. That is to say, we, instead of holding our full target allocation in traditional fixed income, we hold some of that in the lower duration fixed income, and that has also been additive from an allocation basis this year. Again, as happy a story as one can write when returns are negative for bonds, but we've been comfortable with our positioning, and fortunately, it has been additive overall to your portfolios. So that leads us to, well, what are the answers on the total portfolio? Here are the preliminary quarterly results for the standard pools. By and large, in line with expectations. A small amount of cash reserve for those, or excuse me, a small amount of cash return for those invested in liquid reserves pool. And as I mentioned, I just talked about the low duration fund. Our active strategies, income and growth outperforming primarily on the strength of those two fixed income numbers we just talked about. Basically in line to slightly behind with the active long-term growth, and a bit ahead, about just shy of a half a percentage point ahead with diversified long-term growth. So in an environment where active struggle a little bit, I'm pretty happy overall with the results that we were able to generate. We don't like to underperform, but when our active strategies are out of favor and we're in line to slightly better, we're happy to see that. The ESG portfolio did have a bit of a rough go of it. More technology exposure in that portfolio in general, and less energy in general. And as a result, it did underperform a little bit in the quarter. On a year-to-date basis, the active strategies, or the longer-term strategies, where the passive approach is in line with equity markets. Again, based on the strength of some of the active performance on the full year-to-date period, both the active long-term growth and the diversified long-term growth generating premiums so far year-to-date. And that's really what we'd hope for in a more difficult environment such as this. So we continue to hopefully diligently stay in, not hopefully, we continue to diligently stay in front of your portfolios. Tim and I review them regularly, and we review with our portfolio management teams, as well as our broader not-for-profit investment committee and our chief investment officer. We stay on top of your portfolios and continue to look for the next opportunities to make sure that we're well positioned as we move forward. So that, Greg, is the end of my prepared remarks, and I would be happy to field any questions.
Okay, well, thank you, Travis. And again, as a reminder, if you have questions, please put them in the Q&A window, and we will get to those. We do have a couple, Travis and Tim, that we can start with. At what point, this is referring to interest rates, would you see as a good entry point to reduce the fixed income underweight?
It's a good question. I've been looking at rebalancing here for the last couple of months as equities have sold off. We're underweight fixed income. We're overweight primarily in our hedge fund positions within the diversified long-term growth. So that weighting is the most, if you will, out of balance. And even then it's a couple of percentage points. We'll be looking at as we head into year end, potentially looking at taking just a redemption from our hedge fund portfolio, which would happen about mid-year into the second quarter before we would see that. And then those dollars would be earmarked to go back into fixed income, I think, at that point. That's the most likely scenario at this point. I think we want to see, I don't want to try and overguess or think that I can outguess the Federal Reserve. That's probably not a very good game to play, but it feels like we're getting closer to the end of the interest rate hiking cycle. And that's not a decision, particularly in DLTG, that we can make that we can do on a dime because of the redemption process for that asset class. So I suspect at year end, we will likely put in a small redemption to try and rebalance some of that overweight that's developed in the hedge fund portfolio, and seek to put that back into the fixed income portfolio. The other traditional only portfolios are pretty close to target. We're not well overweight equity by any stretch. Those are hewing pretty close to target.
Okay. With the sell-off in the public markets this year, how are private investments performing in comparison? And does that impact returns on DLTG significantly?
So excellent question, and something we'll increasingly add to the webinar info. So private markets, as implied by the question, for those that are less familiar, private markets tend to revalue or reprice with a reasonably considerable lag. So the valuations that we use for your performance reporting are, generally speaking, at least 3 months old. And so the activity that we've seen in the first 3 quarters of this year from a public markets pricing is only now starting to filter its way into your private portfolio. So we're starting to see some modest markdowns. Nothing, and Tim sees a lot of these as well, so I'll ask for his input here. In your portfolio, I've not seen anything terribly dramatic at this point. Negative returns from the private equity should be expected. Public markets can't really sell off like this and not have an impact eventually on privates. So we should expect to see some negative returns, but up to this point of the year, they still have remained a stabilizing factor for overall returns in the portfolio. Tim, I don't know if you have anything to add there in terms of other private numbers you have seen so far this year.
Sure. Yeah, a number of the GPs that I've talked to in the past couple months, past quarter, since we've seen those 630 valuations are generally that buyout funds are going to be marked down in the area of 3 to 5%. Venture capital and growth equity that are more dependent on external financing, more sensitive to interest rates, those markdowns are going to be closer to higher single digits. But certainly nothing to the extent that we've seen year to date in public markets. One comment that they have made is that because of the higher interest rates, there's been a slowdown in transaction and exit activity. So that has led to kind of a little bit of a headlock where only the top tier companies and assets are transacting. And as a result, the funds are more likely to hold investments either at cost or the last round of financing, or absent any transactions in the markets, they don't have updated pricing. So that's why we've seen a little bit of a less meaningful markdown in private markets in the kind of the mid to upper single digits.
Okay, very good. Another portfolio positioning question related to emerging markets. In light of the strong dollar, which you highlighted, and the potential, obviously, for global slowdown or recession, are you rethinking the overweight position, for emerging markets?
We are talking about emerging markets and positioning in our investment committees now. We're considering a number of things. We have just due to other market activity, we're not as overweight in the position today as we might be if we had perfect liquidity. So we're overweight some, but we're not overweight as much as we might otherwise be. We continue to talk about the impacts of China, and they've just wrapped up their 20th Party Congress. They have some views that will have some impacts, and we're still doing research in there. So I think we're sort of in a continual mode in reviewing our overweight emerging markets allocation and whether that's something we want to continue to maintain. We're also going to go through strategic allocation reviews on our long-term plans for all the portfolios this quarter with your investment committee, and we'll be evaluating, where we sit relative to the global market cap. As you may recall, we may have mentioned it previously, but we start with a global market cap as our home base for global equity allocations, and we'll be reassessing where we sit relative to that. Anything we want to do structurally or strategically in terms of positions versus that, and then aligning our dynamic views thereafter. So we are currently reviewing that. Nothing that we think needs to happen tomorrow, and clearly there's a lot of market volatility. So we want to be mindful of changes in the midst of market volatility, just because the reversals have been so dramatic. We want to be mindful about making changes in such an environment as well, just to not get sideswiped by a reversal in the marketplace.
Okay. Well, and this might be our last question. Let's get another one in. And I believe in your preliminary remarks, you may have addressed some aspect of this, but just to be safe. So with the rise in interest rates, does this impact your thinking in terms of U.S. equity allocation, meaning growth versus value, small versus large, from a style standpoint?
At this point, we want to be reasonably style neutral, with the notion that that particularly in our U.S. equity portfolio, we are biased towards quality. In a rougher economic environment, or in an environment where interest rates are going to rise and therefore corporate debt payments, the ability for corporations to stay current on their debt becomes more challenged through both increases in the interest payments as well as perhaps slowing of their businesses. We want to be focused on a higher quality by and large. And so you may recall we had a modest bias to smaller cap stocks that we took off earlier this year. We rebuilt our lower volatility allocation as a result. We're comfortable with that. That positioning doesn't perform as well when we get a lower quality growth rally like we did in the summer, and we're okay with that. I think quality is we want to live through this period and then reposition as it appears we're starting to come out of it, and maybe take a little bit more risk at the margin. But right now there's an awful lot of unknowns in the marketplace, and we still have not seen a meaningful move lower in earnings expectations, which seems incongruous with also a lot of the noise that you hear about the potential for recession. And again, we don't know if earnings are going to come down or not, but do you think there's a risk? We don't know if there's going to be a recession or not, but we think there's a risk. And because of that, we don't want to necessarily position ourselves away from neutral ahead of that. And because those kinds of things, if you get them wrong, those are hard to come back from. So in the meantime, we're happy to sit closer to our long-term plan while we watch that play out.
Okay. Well, no more questions. So thanks once again, Travis and Tim, for sharing your insights with our donors. And we certainly thank all of our donors and participants on the line here. We hope you found this webinar informational. And just a reminder, we will be posting a recording, putting a link to the recording on our website as soon as possible. So with that, we will conclude this webinar. Thank you very much.
Thanks, everyone.